Well, it's the budget day, and what better to get the FII voice to get a sense as to what they are watching out for. Vikas Pershad, the portfolio manager, Asia Equities, M&G Investments, joins us right there from New York. Hi, Vikas. Thank you so much for staying up for us. I'm not sure if you're going to stay for another 3 to 4 hours to hear the finance minister speak, but what exactly are you watching out for? Policy continuity?
Hi, good morning. It's wonderful to be back. We last spoke just before the election results came out, and same as that day, I will indeed be up for the entire India session. So what are we watching for? I'll say a couple of things. One is the budget is coming at a good interesting time because we're in the heart of earnings season now. And the earnings that we've seen thus far, I would say are mixed, are neutral to probably slightly disappointing, in contrast to the previous quarter, in which I thought the earnings results were neutral to slightly positive. So in that context, I think we're probably going to see a little bit more volatility around the budget than we would have had it come 2 months ago or 2 months from now. I've been watching the scroll on the screen and what brokerages are saying. For now, our view is not too different. CAPEX beneficiaries, clearly, people have an eye on those. The housing finance names, people have an eye on those. I think derivatives of consumption, especially in the rural areas or beyond the metros, that's something that we were watching for. That's something we were positioned for also. We've switched up much of our auto positioning, as an example, over the past 4 to 6 quarters from four-wheelers to more to CVs and to two-wheelers. We think that they will be better beneficiaries. And then also in the two-wheeler space, the companies that are the key suppliers of the leading two-wheeler companies. So that's what we have our eyes on. Broadly, though, the long-term India story remains intact. We spoke about this almost 2 months ago when the election results came out. This remains a very long-term opportunity for investors to be here. Short-term, if I can just add one thing, what Deepika and I have been talking about and what we have been telling investors over the past few weeks is that it seems like we're in one of those moments now where we will outperform, or the chances to outperform will come more from what you don't own rather than what you do own. And in Q2, we benefited greatly from owning auto parts companies, from defense companies, CAPEX beneficiaries. A lot of those valuations look fully baked now, and that's I'm saying that. So we have moved some capital elsewhere. So I think the opportunities for relative performers will come from what you don't own in this quarter, as much, if not more so, than what you do own.
I'm going to come to that else in just a bit, Vikas. But, purely from a budget perspective, of course, there's a lot of increased chatter in what the government is going to do this time around in terms of higher allocations to states where they don't have a majority, Andhra Pradesh, Bihar, etc. Is that going to be a market worry? And then, of course, we've heard it time and again, all the powers of corridor talking about warning investors against the kind of risk that the retail is taking up when it comes to options trading. So do you think some curbs to F&O trading could come about? And of course, the big one to try and curb that, perhaps some tinkering on the capital gains tax that I'm sure is not going to go down well with the markets.
Okay, so let's start there because I think that is something that we do spend more of our time thinking on, more than interest rates, more than the rate of inflation in the short to intermediate term. It's this exact issue. If we look, if the numbers I've seen are correct, the retail inflows last year were 1/3 of what they are today. So they've tripled in a year. The Indian options market, again, last I've seen, accounts for 80% plus of all options traded in the world on a daily basis. More than $5 billion of premium, $5 trillion of notional. I tell investors and colleagues and people around the world all the time that the SEBI and RBI are two of the best financial regulators in the world, if not the best. And I've got to think that they have their eyes on this. It's hard to make a prediction, but any hiccup in the flows here, even in the short to medium term, I think will have a direct impact on small and mid-cap positioning in particular. And for that reason, we have curbed the incremental allocation to that space. We have been more focused on large caps. For this reason. This is more than just a tactical trade. It's something that we're thinking about. So I think that is the right reason. There could be something there. In the short term, it would not be great for markets, as you highlighted. The long-term story remains intact, but this is something that we are thinking about on a daily basis. So if you look from the end of 23 to the midpoint of 24, our allocation to small and mid-cap names and off-benchmark names increased substantially. The pace of that increase has halted. And so we're waiting. There will always be more opportunities. Part of the reason is there's so many companies coming public now, so we've saved some capital for that. Our cash remains very, very low. We're fully deployed, but it's easy to, given the names that we're in, to move around into IPOs. So that you're asking the right question. That's my view, is that this is something that's more of a concern than the short-term inflation rate or what the interest rate is, or what the GDP growth rate is in this particular month or this quarter. Coming back to your question on the budget, we are prepared for some sort of stimulus, direct or indirect, to help consumption, rural consumption in particular. I saw again on the scroll some of the names, like the staples names that are thought to be beneficiaries of this. It's more complicated than direct stimulus from the government, but I think that would help. They already trade at pretty high valuations relative to the earnings growth that they are set to deliver. So our positioning there is quite concentrated in the staples sector. We don't own many of the names, similar to IT services. We're in the mega cap names, not in the small and mid cap names. And what we've seen in earnings there also justifies that thus far.
Statement that outperformance will come from what you don't own rather than what you own. You've trimmed position when it comes to auto, very concentrated when it comes to IT and consumption. But are you worried about the earnings growth at all? Because this quarter so far, we have seen a bit of an earnings decline, and even financials for that matter haven't really performed. So where incrementally are you putting money to work? I'm sure it can't be PSUs, because that too is very elevated right now.
Yes, well, Aisha asked me this the day before, the day the election results came out, and the day after the exit polls came out, we took an opportunity to lighten our positioning in some of the PSUs, in defense in particular. I am surprised by the rapidity of the rally there, and so we have taken advantage of that to further reduce our exposure to PSUs, including the defense sector. We are still positioned there, but much less so than we were before. Some of that capital has made its way into the private sector banks. And what you see is, even with underwhelming results from some of the leading private sector banks, as we saw over the weekend, the market gravitated towards them. The market has gravitated towards the large cap IT services names, some of the staples names. And the signal there is that there is nervousness about valuations in some of the sectors. If you look at the CAPEX infrastructure companies, so the infrastructure derivatives, some of the names there, yes, the order books are very large. Yes, the earnings delivery has been beating expectations the last few quarters, but then also you look at the valuation, even on an intermediate sense, and it means to us that we should be underweight there. So private sector banks is one area that we have added more capital to. We have reduced some of our holdings in PSUs, as we said, and concentrate more of the capital in the stable space, because we don't think that overall the enthusiasm that the market showed right after the election results, we didn't think that was justified. Also, what I will say is that, again, we have saved some capital. There are some very interesting IPOs that are coming up in which we are likely to invest. Not so much in the tech sector, healthcare broadly defined, some of the manufacturing names, and some of the semiconductor companies that are part of that supply chain. Also, we're pretty excited about those.
Vikas, thank you so much then for staying up till late. And next we'll chat about what, if at all, a Trump victory would mean for equity markets for the world at large, not just US.
Yeah.
But see you again soon. Let's talk about...
If you like this video, then like, share and subscribe to ET Now.